The headlines over this last week have been exaggerated about the extent of the drawdown in the market. This pullback has given the mainstream financial media plenty of ammunition to attract viewers. And of course, that's what television and radio are all about, is how do you get viewers or listeners? Because the more you have, the more advertising fees you can generate. Viewership determines pricing in the marketplace of media. And Friday was no exception. And actually, Friday was the sixth negative day in a row, which what really breaks a lot of uptrend that we've had. But it has not been all that disastrous. If we take a look from the high, on average, the major indexes are down 1.5%. So we had this kind of news during the day on Friday, and only one of them is Nasdaq's down more than two. The others, there's the S&P 1.6 and 1.2. And then at the end of the day, towards the end of the day, we got buy the dip activity coming in, and then professionals in the last few minutes of the day changed the direction. So we still closed down, but they're basically set up for expecting retail investors on Monday are going to be panicking and continuing to sell their positions out. And that's basically an opportunity for the professional side of the market to make money with short sales, which they will then cover probably within the first 15 to 30 minutes and see what happens with the market after that. But the professional side makes a lot of money on these days when retail gets scared. But we track data, and we've shown you these data slides. This is part of tc2000.com. And this was end of day yesterday. So the NASDAQ did end up down more than 1.5%. Let me get a laser up here. So it ended down 2.2. S&P down 2.3. Well, and the Dow's down 3. But the Dow doesn't have a lot of tech stocks in it. So it's heavy with energy and pharmaceuticals. So interestingly, healthcare was attracting buyers yesterday. On Friday. The issue from a portfolio standpoint is a combination of factors that need to be considered. And it's a relatively simple process. You need a positive price trend, a positive relative performance, and positive asset flows. These are three important factors. And if you can find a way to track these, which is what we do, you've got trend, performance, and conviction. They're the cornerstones of identifying sustainable market leadership. This is kind of a multi-horizon approach, which gives investors a dynamic lens through which to view the market in a multidimensional way. And it matters because trend is important. If price isn't appreciating, we're not interested. We say this all the time. If there's no money flowing into the asset, price cannot go up. The only reason prices rise is because there's high demand. Positive price momentum is non-negotiable. And then there's relative performance. So there's most of the time it's a function of, as far as the financial community is concerned, if it isn't beating the S&P 500, then that's an opportunity cost. Our benchmark is basically it has to be doing better than cash, because if you can just put it in cash, not lose money and make some interest, that's better than owning a great idea and losing money. Investors deserve better than just simply the average. No argument that it's not tough to achieve. It requires these three characteristics: trend, relative performance, and positive asset flows. And somebody has to monitor that, pay attention to it, and have a decision tree that they adhere to and follow the decisions even when their guts say, I don't want to do this. Perry and I have that discussion from time to time. We're sitting there saying, we don't like doing this, but this is why we have rules and why we're going to do what we do. Now, the asset flows are important because capital inflow indicates directional conviction. It's real money moving with purpose. It's the ultimate vote of confidence from institutional players with skin in the game. And it's a lot like Who Wants to Be a Millionaire. In the Who Wants to Be a Millionaire TV series, when somebody was stumped, they had three options. And the option that was always the best source to get the information was the audience. It wasn't a specialist they knew or a personal friend or even guessing out of their own memory bank. It was going to the audience. And that's what the stock market is. It is the audience of the world of investors focused on the US market because that's where most of the money is in the market. It's the biggest market in the world. They're voting with their money with conviction that they're doing the right thing. What's important with a day like Friday or last week with the selling that was going on is not jumping to conclusions. I mean, you're drawing a conclusion without taking time to evaluate the evidence or reason through a logical argument. That's important, and that's what rules give you. Rules and the data, we just showed you a recent screen, that will resolve, eventually it'll resolve your anxiety. Initially, you may still be a little anxious pulling the trigger to say, okay, I'm going to buy or sell this particular one because these are my rules. This is what I'm going to do. That's kind of what it appears that Secretary Bessent is actually doing with the Treasury market. And this is important because the Treasury market is really replacing the Fed as far as impact on the market with what's happening with government funding and the Treasury market itself. The Fed can be somewhat restrictive, but when the Treasury can actually override the impact of the Fed's decision by the way they fund the debt that we need. And currently the government, the Treasury Department is low on the TGA. That's the government's cash account. And instead of doing the normal long-term financing, Secretary Bessent is loading up on short-term treasuries at lower interest rates than would be incurred if he used traditional 20 to 30-year financing. This is a better decision than what Janet Yellen was doing when she was chair of the Fed, which was ignoring interest rates and going ahead and committing us to even higher long-term treasury rate expenses that we have to pay as taxpayers. Bessent is using the market to make a management decision, and that is favorable for us. Now, we know that the Fed decision was status quo. And we also know that two of the governors did something which hasn't happened in decades, voted against the status quo and said we should lower rates. Once that was done and the policy speech was made, the questions were asked, and the answer was basically same-o, we actually can assume that Fed Governor Kugler also objected but didn't want to vote during the meeting because she just turned in her resignation effective August 8th. I mean, it's not like I'm going to hang around here. I am out, no longer. Now, maybe she's got personal reasons for doing this. We don't know. The reasons weren't given. But it certainly seems suspicious because this now opens the door for President Trump to appoint somebody to go in here. And that opens the door for a debate on whether or not he can take that new appointee and appoint them chairman of the Fed. Either way, whoever the new appointee is going to require Senate approval. And the Democrats are doing everything they can to not make a Senate approval easy for whatever position. So that's on top of what happened with Vice Chair Waller and Chris Waller and Vice Chair Bowman, who expressed their opinion. They didn't want to be there, or they thought interest rates should be lower. Then on top of that, right afterwards, we ended up with this news announcement that came out. It was on Fox. And that is that Trump fires the Commissioner of Labor Statistics. Well, she hasn't been around all that long in that department, but the problem with the BLS and its labor surveys is ever since COVID, employers quit answering these surveys, but the BLS needs to put out answers. How many people are working? How many people are not? They're making up numbers. 30% of the data that they're releasing is fabricated. Now, we're assuming that they're fabricating it with their back office room of multiple economists and financial people, or they could just be using AI and say, what do you think should be happening here? What number should we don't know. And that's frustrating Trump because he thinks that we need lower interest rates. And the general consensus in the financial community is that interest rates are too high. The Fed should be at least a full percentage point lower than they are now. And this opens up the door to get somebody who is more inclined to pay attention to what's actually going on in the market. Whoever it is going to have the same problem if businesses don't respond to the survey that they put out on a regular basis. Somebody's still going to have to come up with a number, but presumably you'll get somebody who is more in line economically with what the president is trying to achieve with economic expansion and his goals for the economy. So that leaves us with this issue as a money manager and as an investor is how do we manage the risk involved? First of all, we have to identify what it is we're facing with. We have to have a process for analyzing it. We have to have rules to take action. Then we have to monitor. We have to control the situation by staying in tune with what's going on. And we basically go through this cycle. Now, how often you go through it? Do you go through it daily? Do you go through it weekly or monthly, semi-monthly? That's a function of your portfolio objectives, how much money you have, how much risk you're willing to tolerate, the time frame before you need the money. So this can modify for individuals and their objectives. The irony is that many people worry about how concentrated the S&P 500 is in only a handful of huge tech companies. Because we've been here before. Perry mentioned it in the first half that the tech bubble, leading up to the tech bubble, people became complacent about the concentration that was in the index. But once they express that concern, they often turn around and concentrate their portfolios in an even riskier handful of stocks. And where they're really doing this, what we see is in the range of new exchange traded funds that come out that are single stock mutual funds. Well, what's the big deal? Well, you could just go out and buy the company stock. The ETF is generally adding leverage. They're actually increasing the volatility risk associated with any one of those individual stocks. And there's a huge demand for them. People are trying to get rich quickly. This is really evident in the demand with younger, inexperienced investors. Now, let's be clear here. Bundling a limited number of stocks, even if we use more than one, do a handful, doesn't make them safe. We've seen this play out before. The fewer stocks you hold and the further away you are from the market you move, the more extreme your returns are likely to become. Your potential gains are greater, but so are your losses. Between 1985 and 2024, the average stock suffered a maximum interim decline of 81%, and more than half of those never regained their previous high. That's according to research at Morgan Stanley. So you need some way to monitor where should you be invested. One of those things is to compare segments of the market, which we do here on a regular basis. Should you be in stocks or should you be in bonds? Should you be in high beta or low volatility, large cap or small cap? Should you be in sectors or in across the broad market? Whether you're dealing with stocks, the same set of decisions is applied to the bond market, the fixed income market. And then it's a function of where are we in the investment cycle or the economic cycle, because the economic cycle has an impact on which sectors of the market are actually likely to do well and which ones are likely to be falling behind and actually causing a drag on your portfolio, which is the big problem with modern portfolio theory. Modern portfolio theory says we don't know what's going to happen next, so we'll just own a little bit of everything. will be exposed to all the sectors. We'll have defensive stuff and growth stuff. We'll have income generating stuff, and we'll have some that isn't. We'll put a bunch of bonds in because bonds by definition are safe. And if I put enough bonds in your account and reduce volatility in the portfolio, you'll survive the downturn. But let's just take a look at where we are right now. The concern is that we're at a market top, and at market tops, that's generally when people are assuming the economy is going to go lower. So you buy basic materials, energy, and staples because these things have continuous demand. What's going to fall in staples, I mean, that's your toothpaste and toilet paper, bread and butter, eggs, your basic proteins at your meat counter. People are going to buy those in good times and bad. So if you move your portfolio into these assets at the top of the market, you should survive fairly well as the market falls. At the bottom of the market, you end up with different sectors. Well, following this kind of process is, and this is where we have been, is this technology, industrials, and basic materials coming back up here. Are we here or not? This is sector rotation. If you're paying attention to this, you simply pay attention to where we are in the market, which sectors are leading, and you buy the sectors that are in leadership. And when they quit leading, something's happening in the economy that's going to change reality for the stock world. Respond to that. How do you do that? Well, one of the ways is you keep track of sectors. So using tc2000.com, which is our primary software, and if you are a retail investor, it costs you about $30 a month to get the same data we get. You can set up the same screens that we use and pay attention to them. It gives you a basis to make decisions. So here we were with, I don't remember if this was end of day Friday or if this was, I think this was end of day Friday. I may have done it during the day, but we'll assume it's end of day. The only two sectors that were having a good day on Friday were consumer defensive. Okay, there's your consumer staples, your bread and butter, milk and sugar, and so on. Healthcare, which has been in a disastrous negative trend ever since Obamacare was started. I mean, it's had a couple of rallies, but COVID really, it rallied there in COVID, and then it peaked and it's back down. It's just a 5-year downtrend. And all of a sudden, buy the dippers, buy cheap value on Friday. And it showed up in healthcare. Utilities are typically a defensive sector because even in bad economy, you need electricity and natural gas. You need power, whether it's a business or work, hospitals, whatever. So this doesn't go away. I was surprised to see that it didn't have an up day. But if we take these basic sectors and we turn around and take a look at something and say, well, here, what's involved in consumer defensive? Well, in the same software, you can quickly find out that you've got your grocery stores, beverages, discount stores, tobacco, household and personal goods, and down the list. And this actually, since COVID, has been in an uptrend, a little sloppy here this year. And this is where we get into trouble. Is this a rollover? Is this rolling over or not? So it looks like maybe this initial reaction here off of this chart is, maybe I should own this. This is okay. It did well on Friday. One more step in the decision tree is to look and see, where is it relative to cash? Well, relative to cash, it's not so hot. So I ranked this on monthly returns. These are the 11 sector exchange traded funds plus biotech, which is that's not one of the standard ones, and plus real estate. But here we are, and here's our consumer staples defensiveness. This is negative in all 1, 2, 3, 4, 5, 6, so all 7 of these moving averages. On a 5-day return, it's down 1.6. On a 10-day return, it's down 90 basis points, less than 1%. And for a whole month, it's down 2.5. None of these losses, except for basic materials, is down all that much. So this is down 5. But we have sectors. Here's utilities. The 5-day return, even though Friday was negative, the 5-day return is plus 1.5%. 10 days up 2.5%. Well, on an annualized basis, those are really strong returns. And it is the only one here. That's bonds are improving over the short-term period. But this is a simple tool. In our rules, if it's below cash, we do not want to own it in our portfolio. If it's above cash, it's a candidate, and then other decisions in the decision tree must be met and positive in order to actually qualify for inclusion in the portfolio. And we can see with these red traffic lights that even though the longer term trend has been supportive, there's some topping out in the market that needs to be paid attention to. Not sufficient to bail just yet, but certainly these are warning lights. If you're just checking this once a week in your own portfolio, you know next week you got to pay attention to something in here, and you put a note on your calendar. You're going to check it midweek to see if you need to make a trade early, or you can go to sleep and just wait until the weekend when you review it again. So in our portfolios, we showed you last month, this is where we were last month, but we run dynamic portfolios. These two are checked on a calendar date basis, the second and the fourth Wednesday of every month. This one's checked every day. They have different universe of acceptable exchange traded funds that these models run on, and they have different risk profiles attached to them as a result. Here's where we are as of Friday's close. And so this one is basically unchanged. There are very few changes here, and there are very few changes here. They're slight, but they're there. Now, as hopefully you understand as I've gone through this, we're not in the prediction business. We're in the interpretation business. Nobody knows how to predict the market. Anybody who does is just guessing, and occasionally anybody can get a good guess. And then, of course, they shout from the rooftops, look how right I was with this forecast. You should follow me. Well, we don't know how right we're going to be until we get there, because markets are dynamic. They're constantly changing. You or somebody you hire needs to pay attention to this. Preserving your account and meeting your financial goals is not a task for slackers. Somebody needs to worry about it, watch, and actually act when there is justification within your set of rules and the changes in the market. If it's not you doing this, then we're an option for you to hire, and we'll be glad to have a conversation with you. You can contact us at this with this phone number or online. Subscribe to our podcast to stay up to date, because between these webinars, we typically post 2 podcasts a week. Might skip one, might add one, but this is going to keep you informed of what we're looking at in the market.